All right, welcome everybody. Welcome. Thank you for joining me. Looks like there are people entering the room, so I'm going to give it a few moments before we kick off. Almost there. We're about to get started. Thank you everybody for being timely. Appreciate that. Okay, a bunch of people coming in. Thank you so much. All righty, so let's kick off. Really grateful that you guys are here joining me on this great class. Classic question, Roth versus traditional. You guys have Roth and traditional IRAs, and if you're a federal employee, you have Roth and traditional TSB. So we're going to talk about what you should do. Should you do Roth? Should you do traditional? Should you do both? Should you do none? We're going to address these questions, but before I dive into the material, I first want to point out, like I usually do, that these classes do not happen in a vacuum. They happen because I have people supporting the work that I do. I have clients, I have members that support the work that I do. So if you know somebody who is a client or a member, go give them a hug, go give them a thank you, because they're the ones that are supporting these classes. And if you too would like to become a client and a member, we're going to talk about that towards the end of today's class. I'll show you how to do that and how to get started. Okay, fantastic. Well, welcome to the United States of America, everybody, where pretty much everything you do, you get taxed. That is right, you get taxed. But I'm sure you've noticed that not all taxes are created equal. There are some taxes which are flat taxes, which means that the rate of taxation stays the same no matter what your income is. So for example, Medicare is a flat tax, 1.45%. Doesn't make a difference if you're making $50,000 a year or $500,000 a year. It's a flat tax, 1.45. However, there's another type of tax, the progressive tax, which means the more money you're making, the higher the rate of taxation becomes. And that's the idea behind tax brackets. So if you guys have ever seen a table that looks like this one, as you can see, depending upon how you file your taxes and how much money you make, that'll determine which tax bracket you are in. So, for example, let's take somebody who is a single person and they are earning $150,000. If you're somebody who's single and you're earning $150,000, which tax bracket are you in? So if you look at the chart over here, you will see a single person. If they're making $150,000, that means they're in the 24% tax bracket. So let's do the math. If they are making $150,000 and they are in the 24% tax bracket, does that mean they're paying 24% of $150,000, which is $36,000 in taxes? Is that what they're paying in taxes? 24% on all 150,000? No. They are not paying 24% on all $150,000. And the reason is because not all 150,000 lands in the same tax bracket. If you look at this chart, you will notice that we're actually going to take his $150,000 and we're going to chop it into pieces. The first 11,000, that gets taxed just at 10%. That's it. The next amount between 11,000 and 47, that gets taxed at 12%. The next amount between 47 and 100, that gets taxed at 22%. And then the next amount between 100 and, in my example, 150,000. So in my example, only 50,000 of this person's income is exposed to the 24% tax bracket. Everything else was exposed to a lower tax bracket. So it turns out that this person is not paying 24% of 150,000 in taxes. If you do the math, it's going to come out closer to like 17%, maybe 18% in that range. That's how much they're going to be paying on their $150,000. So your marginal tax bracket doesn't really help you calculate your effective tax rate so easily. So why do I ever need to know which tax bracket I'm in? It doesn't help you do the math any faster. So why do I ever need to know which tax bracket I'm in? And the reason is because any dollar that you successfully shave off your income is going to be avoiding your top tax bracket. So let's go back to the same example. The person who is making $150,000. Let's say he takes 10,000 of those dollars and he puts it into his traditional TSB. So in the eyes of the IRS, how much money did he make that year? Well, not 150,000 anymore because he put $10,000 into this traditional TSB. So in the eyes of the IRS, he only made $140,000. So those $10,000 that he put into his traditional TSB, they were going to be taxed at a 24% tax bracket, but he avoided the loss of those 24% taxes. So it turns out that he, through his traditional contributions, avoided the loss of 24%. Now, the truth is, the example I just gave you was not perfectly accurate. It's true, he avoided the loss now, but he's going to end up paying the taxes later in the future. So it's not that he really avoided the loss, it's more like he deferred the loss into the future. There's actually very few instruments that allow you to avoid the taxes now and also avoid the taxes later. There's very few instruments that allow you to do that. However, we have spoken about them recently in recent classes. You may remember the HSA and the FSA. If you contribute to HSA and FSA, you'll be saving not just federal tax, you'll be saving state tax, you'll be saving Social Security and Medicare. If you add all these things up, it's going to translate to about 37.65% of tax savings. You don't pay the taxes now in the HSA, and if you take the money out for medical purposes, you're not going to pay the taxes on that money in the future. So you literally save 37.65% on your HSA, FSA contributions. But with your traditional TSB, you're not avoiding the 24% tax. You're just deferring the 24% tax into the future. Now, when I say the future, what do I mean by the future? Which future am I talking about? So I'm sure you guys know that your TSB is earmarked for retirement. Most people, they tap into their TSB in retirement. And in retirement, is your income going to be higher or lower than it is right now? Now, the truth is, the answer is actually dependent upon where you are in your career. Because if you're just starting your career, it could be that your future retirement income may actually be higher than your current income right now. So brand new employees, it could very well be that your future retirement income is going to be higher than what it is right now. But the mid-career and the pre-retirees, it could very well be that your income in retirement is going to be lower than it is right now. I mean, just imagine someone who is a pre-retiree, you're making whatever your salary is. When you retire, your FERS pension is only going to be replacing about 30%, depending upon how many years you worked. But let's say 30% of your salary is going to be replaced by FERS, another 20% by Social Security. So your retirement income may be cut in half. So if you are doing the traditional, right now you are making your income at whatever level it is. In retirement, there's a very good chance you're going to be making less money. Now, here is where we have to pay close attention. It's true that most of us are going to be making less money in retirement. It's true. But does making less money automatically put you into a lower tax bracket? Well, if you look at the charts over here, you will see that no, making less money does not automatically put you into a lower tax bracket. In order for you to fall into a lower bracket, your income has to drop enough lower so that you drop into low bracket. Notice how every single bracket on this chart has a range. So back to the example I gave you of somebody who's making $150,000, they're in the 24% bracket. If their income drops from 150 to 110, they are still in the 24% tax bracket. Okay, so just because you're making less money doesn't necessarily mean you're going to be in a lower tax bracket. However, My assumption for most of you is that you will be in a lower tax bracket when you retire. My assumption for most people in this room, I believe, are in the 24% tax bracket right now. I know that there could be that there's some people in this room that are in the 32% tax bracket right now. That could very well be the case. But my assumption is most people in this room are going to be in the 24% tax bracket now. And when you retire, your income is going to drop enough so that you're going to fall into the 22 bracket. So again, you're in the 24 bracket now, and in retirement, you're going to be in the 22 bracket. So if I gave you the choice, you could either pay the taxes on your income right now at the 24%, or you could defer it until retirement, where your income drops, you'll be making less money, and you'll be in the 22 bracket. If I gave you the choice, you could pay taxes at 24 or 22, which one would you do? And I think we would all agree that I would rather pay less tax, not more tax. So if I have the choice, pay more tax now at the 24 or pay less tax in the future at the 22, hello, of course I'm going to pay in the future. I'm going to wait for my income to go down in retirement, and that's when I'll pay the taxes. And by the way, that is correct thinking. That is what I've called the conventional wisdom. The conventional wisdom will have us thinking that we're going to be making less tax in the future. We're going to be in a lower tax bracket. So we might as well not pay the tax now. We might as well wait to the future. And therefore, if you follow that thinking, you should be contributing to your traditional TSP, traditional IRA. Again, let me run that through again. The way the traditional works is you defer the taxes into the future. So with the traditional, the money that you put in, you're not paying the taxes now while your income is high. You're paying the taxes later when your income has come down. And since the conventional wisdom has us believing that in the future, our income is going to come down and we're going to be in a lower tax bracket, so therefore, we're better off deferring into the future. So the conventional wisdom would have us all believe that we should be contributing to the traditional. That's the conventional wisdom. But I'm sure you know by now, I'm here to challenge the conventional wisdom. And we're going to run through the numbers. We're going to compare the traditional math to the Roth math. If you guys can imagine, the traditional Roth conversation is basically evaluating which rate of taxation is going to be higher. Is it going to be your rate of taxation now or the rate of taxation in the future? So if you guys could see my face, I'm going to draw an arbitrary line right here by my eyeballs. This is your rate of taxation right now. Your tax rate in the future, when I say future, for most people, it's going to be retirement. Your tax rate in the future is going to either be the same that it is right now, higher, or lower. Is there a third possibility? Is there a third outcome? No, those are the only three possibilities. It's what I call a stable tax environment, a rising tax environment, a falling tax environment. Stable, rising, falling. Those are the only three possible outcomes. So because those are the only three possible outcomes, let's run the math in every one of those outcomes, and we will see who has the advantage. Is it the traditional? Is it the Roth? So let's run the numbers. Now, before we look at the next slide, let me warn you, the next slide is going to be a complicated Excel spreadsheet. There's going to be a lot of numbers coming at you all at once. It's going to be very intimidating. However, once you get oriented to the Excel spreadsheet, it really is actually not that hard to understand. So just don't panic on me. Maybe take a very deep breath before we take the next slide. Okay. Wow. Okay, a lot of numbers, a lot of numbers. Let's look at these numbers together. So I have my Roth and my traditional investor. And remember, everybody here has access to the Roth TSP. Let me say this again. The same way IRAs offer you a traditional option and a Roth option, so too the TSP offers you a traditional option and a Roth option. What's the difference between traditional and Roth? Very simple. The traditional, you don't pay the taxes now, you defer the taxes till later. The Roth is just the opposite. With the Roth, you pay the taxes now, but you pay zero taxes later. Like all the gains that you get, zero taxes later. And everybody here has access to the traditional TSP and the Roth TSP. And good news, there are no income limitations on the Roth TSP, meaning you could be making as much money as you wish. You can be making as much money as you want, and you could still make a full contribution into the Roth TSP. Oh, and good news, if you make your contributions into the Roth TSP, you're still going to get the agency match. That is exactly correct. You're going to get the match, the agency dollars. However, the agency dollars go into the traditional. Okay, that's just the way the law is right now. There is some possible changes coming in the future, but right now the way it works is even if you do all your contributions into the Roth TSP, you'll still get the 5% match, but the 5% match of the agency dollars, not your dollars, the agency dollars, that goes into the traditional. So everybody here, you have access to the Roth TSP. You could still make the contributions to the TSP no matter how much money you're making. You're going to get the match, even if you do Roth. And the contribution limit for the TSP this year is 23,500 plus there's an additional $7,000 catch-up contribution. Excuse me, just opposite 23,000 plus the 7,500. So that's a grand total of 30,500. Just got to do the math very quickly. Fine. So everybody here could do the maximum contribution to $30,500 contribution into the TSP, no matter if you're doing Roth, no matter if you're doing traditional. Fine, very good. Let's now come and watch the numbers play themselves out. So I have in this illustration, I'm showing an investor contribute $10,000 into their TSP. Now remember, they could contribute more than $10,000. They could contribute up to $30,500 if you're doing the catch-up contribution. And that's true whether you're the Roth, whether you're the traditional, you could do $30,500. In my example, just to keep the numbers nice and round, I did a $10,000 contribution. And the $10,000 money, how does it perform? Well, it performs however I allocated the money. Let's say I allocated the money in the stock market, and the stock market goes down, it goes up, it goes down, it goes up, it goes down, it goes up, it goes down, it goes up. Whatever happens in the market, that's what happens. And your $10,000, it grows and it's worth $36,000. So that means both the Roth and the traditional investor, they both invest the same amount of money, and that money grows to be worth $36,000. This is true because we have yet to factor in taxes. And that's what we're going to do on the bottom. As you can see in the bottom, there's the tax rate on the way in, there's the tax rate on the way out, and we have our three environments: stable, rising, falling. Let's start with the stable environment. I want everyone here to see this math. Okay, stable environment. So the tax rate on the way in and the tax rate on the way out are the same tax rates. So let's give the example. Let's say the 24% tax bracket. So that means if I have my traditional and my Roth investors contributing $10,000 to their TSP, one of them is saving 24% on the way in, but the other one is not saving 24% on the way in. Can anybody guess which one is saving 24% on the way in? And that is the traditional. The traditional saving 24% on their $10,000 investment. What is 24% of $10,000? Oh, here it is in the next column over. It's the 24% savings. So that's $2,400. So that means that the traditional investor literally has extra money in their hands because they saved in taxation. They have an extra $2,400 that year in their hands. By the way, let me just make this absolutely clear. Is there anybody in this room that is doing traditional right now? I'm assuming that's the majority of this classroom. The majority of people here are probably doing traditional contributions. And let's think about what that does to your take-home pay. Did you know that had you done Roth contributions as opposed to traditional, would you have more take-home pay or would you have less take-home pay? So remember, the way the Roth works is your contributions to the Roth are taxable right now. You're not deferring it to the future. You're paying the taxes right now. So that means anybody who would be contributing via payroll to their Roth TSP, they would have more tax being withheld from each paycheck right now. However, for those of you who are doing traditional contributions, you have less taxes being withheld from each paycheck right now. So what this means is anybody here who's doing traditional, you literally have more take-home pay every single pay period by your contributions to the traditional TSB. And what could you do with that extra take-home pay? Well, you could prudently invest that money. And that's what I'm illustrating on this slide right over here. If you had that $2,400 extra money, you could invest that money. And how does that money perform? I have it performing the exact same. The performance is going to be the exact same. It goes down, it goes up, goes down, it goes up, goes down, it goes up, goes down, it goes up. And at the very end, it's worth $8,814. And again, let's remind ourselves, who has this extra $8,814? The traditional investor. The Roth investor would not have that money. The traditional investor has that $8,814. Okay, now it's time to take the money out of the retirement account. Now, when you take your money out of your TSB, you do not have to liquidate your entire TSB all at once. You could take a little, you could take a lot, big chunks, small chunks, whatever it may be. In my example, I have them liquidating $36,000. Okay, now again, could they liquidate more? Could they liquidate less? That's up to them. But in this case, I have them liquidating $36,000. So let's see what happens. If you're a Roth investor and you take out $36,000 from your TSB, do you pay taxes on that $36,000? No, you do not. In which case, you end up with $36,000. So you'll see in the bottom right, in the stable environment, the Roth ends up with $36,000. However, if you are the traditional investor, when you take your money out of your traditional TSB, are you going to owe taxes? Yes, of course you're going to owe taxes. And how much are you going to owe in taxes? What is your tax rate in retirement? So in the stable environment, that is the very first situation we're running. In the stable environment, the tax rate on the way out is the same as the tax rate on the way in, which is 24%. So that means the traditional investor will have to pay 24% taxes on $36,000. Can anybody do the math? What is 24% of $36,728.52? Math, you will see it's exactly $8,814.84. You know what this means? This means the traditional investor has to pay 24% tax on the way out. That's true. But after he subtracts out the 24% on the way out, he could just add back in the 24% tax savings, which he has grown to be worth $8,800. So it turns out that the 24% tax savings from the beginning pays for the 24% tax liability at the end. Exactly. So in a stable environment, who wins? As you guys can see, in a stable environment, everyone's a winner. Everyone's a winner. Not so fast. I made a major assumption. I think some of you detected my assumption, but let me go through it again. And when I hit my assumption, I'm going to highlight it in slow-mo. So here we go. So they both end up with $36,000. Does the Roth pay tax on the way out? No. Does the traditional pay tax on the way out? Yes. So he has to subtract 24%. But after he subtracts 24%, he can add back in the 24% savings, which he has grown to be worth $8,800. Did anybody detect my assumption? What am I assuming? I am assuming that this traditional investor will take their 24% tax savings and invest it and grow it. But what would happen if this traditional investor would behave like every other American on the planet? Please tell me, when you guys save in taxes, which you do every single pay period, when you guys get that extra take-home pay every single pay period, what do you do with that extra take-home pay? Do you prudently invest it right away? Or do you spend it right away? Because if you do not prudently invest that tax savings, will you have the $2,400 grow to the $8,800? Well, if you didn't invest it, you will not have the $8,800 at the back end. And if you don't have the $8,800 at the back end, then who wins? Ooh, the Roth will win. So as you can see on paper, in the stable environment, everyone looks like a winner. But Roth has what I call the real world advantage. In the real world, nobody invests their tax savings. And that makes all the difference. Wow. Okay, that was heavy stuff. And that was just the first environment, the stable environment. Let's move on to the second environment, the rising environment. Rising environment, tax on the way in, tax on the way out. Tax on the way in is 24%. Tax on the way out is 32%. So let's go step by step. Which investor saves taxes on the way in? Correct. It's the traditional investor. The traditional investor will save 24% of their $10,000 investment. What's 24%? Again, it's $2,400. And what could he do with that $2,400? Of course, he could prudently invest the $2,400 of tax savings. Fantastic. Now it's time to take the money out. So they both end up with $36,000 in their TSB or in that for that $10,000 investment. When the Roth pulls out the $36,000, does he pay tax on that 36 on the way out? No. Does the traditional pay tax on that $36,000? Yes. How much tax? Ouch. 32%. Yikes. So that means that the traditional investor has to subtract 32% from their 36,000. Yes, they could add back in the 24%, which they have grown. But even then, the 24% is not enough to make up for the loss of 32%. So in a rising environment, who wins? As you can see, Roth. Rising, Roth. Rising, Roth. Oh, and by the way, that's in the fake world. What would happen in the real world? In the real world, would the traditional have invested their tax savings? No. Would they have the $8,800 at the back end? No. So in the real world, the Roth would win by even more. Wow. I just ran 2 out of the 3 outcomes, and so far Roth has the advantage in both of those scenarios. Now let's go to the third outcome. The third outcome is the falling tax environment. The falling tax environment is, let me remind you, the falling tax environment is the conventional wisdom. Remember what we said earlier? The conventional wisdom is that right now your income is higher than what it's going to be in retirement. In retirement, it's going to be lower. And the conventional wisdom also assumed that when your income is lower in retirement, it's going to be low enough that you will be in a lower tax bracket. So in this example on the board right over here, I'm illustrating the conventional wisdom, where in retirement, you're going to be in a lower bracket. And if that's true, let's see who wins. So step by step. Tax on the way in is 32%. Tax on the way out is 24%. Let's start on the way in. 32% tax savings. Which investor is saving 32% on the way in? The traditional. And what's 32% of $10,000? Here it is on the rightmost column, $3,200. The traditional investor literally has $3,200 extra dollars in their hands. And what could they do with that extra $3,200? Of course, they could prudently invest that money if they choose to. And that $3,200 could grow to $11,000 at the back end. Perfect. Now it's time to take the money out. Of the $36,000, does the Roth pay taxes on the $36,000? No. So he ends up with $36,000. Does the traditional pay tax on the $36,000? Yes. So that means he has to subtract 24%. But after he subtracts 24%, he can add back in the 32%, which he has grown. And the 32% more than compensates for the loss of the 24%. So in a falling environment, who wins? In a falling environment, traditional. But let me remind you, that's in the fake world. That's only if you prudently invest your tax savings, which nobody does. If you do not prudently invest your tax savings, then will you have the $11,000 at the back end? No. And if you don't have the $11,000 at the back end, then who wins? Then the Roth has the real world advantage yet again. Oh my goodness. We just ran through all three possible outcomes. And on paper, they look different, but Roth has the real world advantage in all three scenarios. Can anybody guess what my conclusion is from this analysis? If Roth has the real world advantage in all three scenarios, can anybody guess what my general recommendation usually is going to be? You guessed it. Roth, Roth, Roth. Roth, Roth, Roth. Now, I know some of you are looking at me right now in great disdain. And you're thinking, oh, geez, Stephen, I appreciate that advice now at the end of my career, but where were you 20 or 30 years ago when I first started? I hear you, and I feel the pain. And let me share with you something. I do have a few exceptions to the rule, meaning my general recommendation is going to be Roth, 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 but I do have some exceptions where I tell them to do traditional. But if you don't fit into any of my exceptions, I still have a consolation prize. Okay, so I could offer you guys a consolation prize for those who don't meet any of my exceptions. Let's start with my exceptions. It could very well be that you fit into one of my exceptions. My first exception are those whose current cash flow is very tight and they need extra breathing room in their cash flow now. If you're in that situation, your current cash flow is very tight and you need breathing room in your cash flow right now, I'm going to tell you to do traditional. Why? How does doing traditional help your cash flow? Because remember, if you do traditional, you have less taxes being withheld every pay period. You have more take-home pay. If you would do the Roth, they would withhold more taxes and you'd have less money every take-home pay. So by you doing traditional, you'll be giving yourself more breathing room in your cash flow, which solves the problem now. Let me just point out something. If you are in this case, if you're in this exception and you need extra breathing room in your cash flow, understand that by you doing the traditional, you're going to have more in your cash flow right now, but you're going to have less post-tax dollars in retirement. Now, that's a fair trade-off. I understand, and I have many clients that have to make that decision. Should I compromise my post-tax dollars in retirement, or should I compromise my cash flow right now? Something's not to be compromised. So if you chose, I want to have more in my cash flow now, even though it's going to be less post-tax dollars in retirement, I totally respect that. I totally hear that. Okay, so that is exception number one. Exception number two. This is a unusual exception. I'm not sure who it applies to. I shouldn't say it's unusual. I should say it doesn't happen too often. That's what I really mean to say. Is there anybody here who has forgivable student loans, meaning student loans that are going to be forgivable after a certain amount of time of federal service? Aha. So let's talk about that for just a moment. If you have those student loans that are going to be forgivable after a certain amount of time, that means after a certain amount of time, 10 years or less, the balance on your student loan is going to be forgiven. Now, here's the thing. Some of these student loans have a payback schedule that is dependent upon your income, meaning the more money you make, the higher your student loan payments are going to be. The less money you make, the lower your student loan payments are going to be. And let's think about this. If you have a higher student loan payment, that means even though your student loan is going to be forgiven, but you have to pay more towards the loan and less is going to be forgiven. If you had lower income, you'd be paying less towards that loan and more would be forgiven. So I have to see how close you are to the threshold of qualifying for a lower student loan payment. But it could very well be that if you are close enough to the threshold where we could lower your income enough so that you would qualify for a lower student loan payment, which will then turn into more of your student loans being forgiven, okay, then I give you permission to do traditional. Okay, I'll give you another exception. Another exception, which again, this does not come up too often, is for those who are going to be getting on Medicare in the near future. And for those who don't know, Medicare premiums are based upon your income levels. The higher income, the higher Medicare premiums. The lower your income, the lower your Medicare premiums. So if I have a client that is close to Medicare age, and if I'm able to lower their income, it may translate into a lower Medicare premium. So again, we have to see how close you are to qualifying for that lower premium. But if you are low and if you are close enough to qualify for that lower Medicare premium, I may actually have you reduce your income so you could qualify for lower Medicare premiums. But let me just throw in a caveat. That all assumes that you're going to be enrolling in Medicare, which, for those who have come to previous classes, we had that discussion. Should you have Medicare? Don't you already have FEHB? So I'm not going to hash that out right now. I would tell you to look at my archive of classes, which is available for my clients and my members, as I mentioned earlier. So if anybody wants to listen to that recording, you could definitely access that if you are a client and member. Anyhow, so that is another exception. I have yet another exception. My last exception is if you are the unusual American that actually invests their tax savings. Is there anybody here that invests their tax savings from every pay period? For example, when you guys do traditional, you have more take-home pay. What do you do with that extra take-home pay? If you spend it, it doesn't count. Okay, then you don't qualify for my exceptions. If you just put it in your bank account and it's earning zero, so then that doesn't help you. However, if you invest it in a way that is matching the investment performance in your TSB, oh, so then there's something to talk about. If you're somebody who takes your tax savings and you invest that money, it can't be that you're doing nothing with it. It has to be you're taking the tax savings and you're investing that money, then I will give you permission to do traditional, but you have to satisfy one more condition. So again, I'm giving my final exception. My final exception are for those who take their tax savings and invest it not in a low yielding instrument, but something that's going to be yielding similar to what your TSB is yielding. So whatever your TSB is yielding, I want you to achieve at least that amount. However, if you are the type that prudently invests your money, you need to satisfy one more ingredient. It's not enough that you prudently invest your savings. You need to also be in a falling tax environment. Isn't that what we're showing on this slide? The traditional only wins in the falling tax environment. So let me ask you a question. Are you going to be in a falling tax environment? Well, allow me to demonstrate that many of you, if not all of you, are not going to be in a falling environment. If anything, you're going to be in the same or a rising tax environment. I'm going to give you guys two demonstrations. The first demonstration is going to be on my whiteboard. So I'm coming to my whiteboard over here. I hope you guys can see this whiteboard. I'm going to draw out your income for the rest of your life. Right now, your income is right over here. This is where you are, let's say, mid-career, pre-retirement. That's where you are. And then when you retire, your income drops. And now you have a new level of income. This is your first pension with Social Security. And your income in retirement rises with Diet Colas. And then all of a sudden, your income spikes. And then from that point, it goes onward and upward. Can someone please tell me, why did your income spike right over here? What happened right over here? All of a sudden, your income spiked. So that is when your required minimum distributions kicked in, your RMD. Right now, the RMD age is 73. However, for many people, by the time you get there, it's going to be age 75. So again, right now it's 73. It's turning to 75. When you have the RMD, listen very carefully, the RMD is calculated as a percentage of your traditional account balances, which means the higher your traditional balances are, the higher your mandatory distributions are going to be. For those who don't know, when you have to take that mandatory distribution, the very first distribution is going to start at 4.3% of your traditional account balances. And then every year thereafter, it goes up 4.5, 4.7, 4.9, 5%, 6%, 7%, ... It keeps on going up for the rest of your life. So I have news for you. Will you be in a lower tax environment when you retire? And the answer is, okay, maybe for a few years. It's a temporary environment that you're going to be in a lower tax bracket. It's just during those few years that in between retirement and the mandatory distributions. And I want to see if your creative juices are flowing. Can anybody spot when you are in this valley, when you are in between retirement and the RMDs, and you're in the valley and you're in that lowest tax bracket that you will ever be in for the rest of your life? Can someone please get creative? Which of my accounts should I be liquidating and drawing from when I am in that lowest tax bracket? And the answer is I should be drawing from my traditional accounts, my traditional TSP, my traditional IRA. Why? Why would I draw from my traditional? Maybe I should draw from my Roth during those years. No, don't draw from your Roth during those years, because remember, the Roth you pay zero tax on. And if the traditional, you're going to have to pay taxes on. So if you have to choose, when should you draw from your traditional accounts? Should you draw it later in life when you're in higher brackets, or should you draw it early in retirement when you are temporarily in the lower brackets? You should be drawing from your traditional during those years. That's exactly correct. So during those years that you guys are in that valley, you should be liquidating the traditional. This way, yes, you'll pay the taxes, but it'll be the lowest taxation that traditional money will ever be taxed at for the rest of your life. So that is my first demonstration that you may not be in a falling tax environment in retirement. Meaning, if you are in a falling environment, it's only going to be temporary, and then for the rest of your life, you'll be back to where you are, and you'll even be higher in the future. That is my first illustration. However, let me give you my second illustration. We spoke about the tax brackets earlier. I may have showed you that the tax brackets were, let me just back up a little bit, back up. The tax brackets right now are these tax brackets. These are the Trump tax brackets. They were introduced by Trump in, 2017, and they're scheduled to expire. Does anybody here know when are they scheduled to expire? They're scheduled to expire at the end of the year 2025, which means starting in 2026, the old brackets are scheduled to return. This has already been voted on. They've already voted that the current brackets are going to expire and the new brackets are going to return. Does anybody here remember what those old brackets are? Again, the current ones are going to expire and the old brackets are going to return. What do the old brackets look like? Here, let me show you these numbers. These are the old brackets. So instead of being in the 24 bracket, you'll be in the 28 bracket. Even if your income drops in retirement, it's not going to drop you to the 22. It's going to drop you into the 25. And the 25 is higher than your current 24. Oh my goodness, you know what this means? This means in retirement, even though you're right, your income is going to go down, but you're going to fall down into a higher tax bracket. Oh my, let me see that again. You fell down into a higher bracket. It seems outrageous, but that's what's going to happen. And let's plug that in to my whiteboard. I'm going to draw out some tax brackets over here. So let's say right now you guys are in the 24 tax bracket. So that is right over here. So I'm going to draw. I hope you guys can see the board. This over here where you guys are right now, that is the 24% tax bracket. And then, and let me draw the lines for this. So the bottom of the 24 bracket, I hope you guys don't mind me doing this. Okay, I'm drawing the lines across. I know it's a little bit squiggly. Fine. This is the bottom of the 24 bracket. And this is the top of the 24 bracket. Okay, it's obviously, not perfectly straight lines. Fine. So any income between these two green lines is in the 24 bracket. Below the 24 is the 22, and above the 24 is the 32. So let me just jot that down. 32. Fantastic. These are the tax brackets now. However, in just a few years, these tax brackets are going to change. And the new tax brackets are going to be, the 22 is going to change to the 25. So even though you thought you're going to be in a lower bracket, what if I told you that the 25 is higher than your current bracket? Oh my goodness. And the 24 is going to turn into the 28. Yikes. Yikes. And then the 32 is going to turn into the 33. Oh my goodness. All these brackets are scheduled to go up. So as you guys can see, I have 6 brackets, 6 possible brackets in your future. 6 brackets in the future. Please tell me, of the 6 brackets, which one is the lowest bracket? Of the 6 brackets that are on the board, which one is the lowest bracket? And the answer is obviously the 22. So of the 6 brackets, the lowest bracket is the 22, which means that if you're going to be in the 22 bracket, that will probably be the ideal bracket to be paying the taxes on your traditional. Is there anybody here who's going to be in the 22 bracket? Well, is there anybody here who's going to be retiring before the year 2026? Yes, I think there are. There are some people who are going to be retiring either this year, 2024, or next year, 2025. So you will have a very short window of time where you will taste and enjoy the 22 bracket. And if you're getting creative, please tell me, what should you be doing when you are in the 22 bracket? You should be liquidating your traditional accounts. And when I say liquidating, you don't want to liquidate all of it, because for example, let's say you have $1 million in your account. If you liquidate all $1 million, that's as if you earned $1 million in 1 year. That will be a disaster. That will skyrocket you to the tippity top tax bracket, which would be totally counterproductive to this entire conversation. So when I say liquidate, what you're going to do is you're going to liquidate just enough to fill up the 22 bracket. Now, how much money will you have to take out to fill up the 22 bracket? That really depends on what is your income and how much room is there between your income and the top of the 22 bracket. It could be that it's only 20,000, 30,000, whatever the number may be. Okay, so it could very well be that you could liquidate 22. You could liquidate 20,000, 30,000, whatever your number may be, to fill up the bracket. Fantastic, fantastic. And you can do that in the year 2024, and you could also do that in the year 2025. Okay, fantastic. However, that's only for those who are going to merit the 22 bracket. However, in just 2 years, the 22 bracket is going to be gone. So whoever doesn't retire between now and 2026, you're not going to even taste the 22 bracket. That's not even going to be an option for you. So if the 22 bracket is not an option for you, what is the next best option? Again, we had 6 options, but if the 22 is no longer available, so then you only have 5 options remaining. So of the 5 options remaining, what is the next best option? So as you guys can see, the next best option is this one, the 24% bracket. 24%, which means that for pretty much everybody in this room, where you are right now is the ideal time for you to be liquidating traditional and converting to Roth. Remember I mentioned before, I had something called the consolation prize. The consolation prize is the Roth conversion. The Roth conversion. Okay? Roth conversion basically means that you take money from your traditional and you convert it to Roth. By the way, let me give you 2 disclosures. Anybody here who wants to do a Roth conversion, here are 2 very important disclosures. Number 1, the TSB does not allow you to do a conversion inside the TSB. If anybody wants to do a conversion with their TSB money, they first have to get that money out of the TSB into a traditional IRA. And then once it's in a traditional IRA, you could convert it into a Roth IRA. Okay? The TSB does not allow you to do Roth conversions. That is disclosure number 1. Disclosure number 2, any amount that you convert is taxable. So once again, you don't want to convert $1 million all at once, because that's going to skyrocket you to the tippity top tax bracket. You only want to convert just enough money to fill up the current bracket that you're in. So if you're in the 24 bracket, it could be that you just have to liquidate and take a distribution just enough to fill up the 24 bracket. And by the way, for those who are retiring and you're going to be in the 22, you may even want to consider taking out more than the 22 bracket and even filling up the 24 bracket. Again, it's going to be taxable. It's going to be taxable. So if you guys are following me, so far I'm suggesting that you do 2 things. 2 things. Number 1 is your future TSB contribution should be Roth. And then my second suggestion is that you should be converting money from your traditional accounts into your Roth accounts. Can anybody guess what's going to happen to your tax liability if you follow both of my suggestions. Is your tax liability going to go down, or is your tax liability going to go up if you follow my suggestions? So your tax liability this year is going to go up. It's going to go way up. And when you see that increased tax liability, you're going to be remembering this webinar and you're going to be cursing my name. You're going to be wondering, why did I listen to this guy? Oh my goodness, look at my tax liability. I can't believe I listened to him. That's a very good point. Why did you listen to me? Look at your tax liability. You're going to be increasing the amount that you're paying in taxes this year. Why did you listen to me? So the answer to that question is something that you need to know to answer. Again, it's not for me to answer. You need to know to answer these questions. The answer to that question is that you're right. I increased the amount of money I'm paying in taxes, but the amount of money that I paid in taxes would have been more had I paid it in the future. It would have been more, not just because my investments have increased in value. It would have been more because I would be taking not 22, 24%. I'd be taking 25% or 28% or even 33%. So you're right, I'm paying more in taxes right now. However, I'll be paying more than that, even more than that in the future if I did not do these contributions to the Roth. If I did not do Roth contributions, if I did not do Roth conversions, I will end up paying the taxes in the future and it will be at a higher level. So I'm giving you guys two choices. Choice number one is you pay the taxes now at a level that's lower than what your future level is going to be. Or choice number two is you can wait until later and you'll pay the taxes at a higher level. There is a third choice, by the way. The third choice is who says you have to pay the taxes? Maybe you could try to defer the taxes as long as possible. Obviously, the RMD is going to force you to take out as much money as it can. But when you pass away, whatever's left over that you have not yet paid taxes on, that goes to your kids, and then it's their issue. Why do I have to deal with the tax issue? Let me just pass it on to my kids, pass the buck. They'll have to pay the taxes. Now, I totally understand that, but let me just point out something, that if your kids are in a higher tax bracket than you're going to be in, then you didn't really save anybody money. You actually left your kids less money than you could have left them. So you really have to ask your kids, you have to ask yourself, your kids' tax bracket relative to yours, is your kids going to be in a higher tax bracket or are they going to be in a lower tax bracket? If they're going to be in a lower tax bracket, so then I understand that maybe you should just defer and let them pay the tax at the lower level. That I hear. But if your kids are going to be in the same or even a higher tax bracket than you're going to be in, then it actually makes sense for you to pay the taxes. This way you leave your kids more money. I know it's annoying. I know it doesn't feel good to pay more in taxes, but you're paying the taxes now just so you could avoid paying more taxes or your kids pay more taxes in the future. I hope I'm making sense on all this, guys. Okay, there is so much more to talk about. I really wanted to get into the non-qualified concept. For those who are unaware of this, there are non-qualified accounts. So up until now, we've been talking about Roth and traditional as if those are the only top two options. However, there is another option. The other option is something called a non-qualified account. For those who don't know what a non-qualified account is, just a fancy way of saying a non-retirement account that gets regular tax treatment. That's really what it is. When I say non-qualified, it just means it's a non-retirement account that gets the regular tax treatment. However, the regular tax treatment is really not that bad, and it offers some benefits. Like, for example, there is the favorable long-term capital gains tax rate. There are no mandatory distributions. There are capital losses that you could harvest and reduce your income. And then ultimately, you could pass that money along tax-free, income tax-free to your heirs with a stepped-up cost basis. That is something, those points that I just raised very, very briefly, those are options that are not really available in your traditional TSB and your Roth TSB. Although the Roth TSB does not have RMDs, that is true. But the other points, the long-term capital gains rates and the RMDs and the capital losses and the step-up basis, that does not apply to your traditional TSB. The traditional TSB does not get long-term capital gains taxation. The traditional TSB has mandatory distributions. The TSB does not allow you to harvest capital losses, and the TSB does not get inherited with a step-up in basis. So anyhow, there's a lot more to talk about, and maybe I should dedicate another class to focusing on the non-qualified accounts. That's probably a very, very good idea. I would definitely have that in mind, but I do see that the hour is late. So for me to go into the non-qualified territory is really going to take us another like 20 minutes plus. So how about for now, let me turn my attention to some of the questions that are in the chat box. I see there's a lot of questions. And so let me see if I could address some of those questions. But before I address the questions, I do want to mention that these types of calculations and these types of decisions are the things that I help my clients and my members with. Okay, anybody here who wants to become a client of mine or a member of mine, you could request a complimentary consult with me. I'm going to post it in the chat box to learn more about what it takes to become a client. So if you guys can see in the chat box, anybody here who's interested, you could request a one-on-one meeting with me, and we could talk about what needs to happen in your financial life to make sure that you're meeting your goals, that you're removing inefficiencies, and we can learn more about the planning process and what it's like to become a client. So anybody here who is able to see that button on the side that says learn more, click on that learn more button. If you click on that learn more button, it's going to take you to a web page, a web form. And on that web form, you'll fill out your information and you will get an email from my team to set up your complimentary consult. If anybody here cannot see that link, I'm going to post it in the chat box. There it is in the chat box. There it is. So whoever wants to click on that link that I just posted in the chat box, you guys could click on that link. Okay, so now let me turn my focus to the chat box. Okay, so someone is asking if I do tax preparation, meaning do I do tax returns? I do not do the tax returns myself. That is something that I definitely delegate to others. That's not my arena. I see Lori's asking, when you start taking withdrawals from your traditional IRA or 401k, where is the money for the taxes supposed to come from? So Lori, if you take a distribution from your TSP, there's going to be a mandatory tax withholding. A mandatory tax withholding, unless you roll it over into a traditional IRA. But if you're just taking a typical withdrawal and you're not just rolling into an IRA, there is a mandatory tax withholding. So that is one place where you're going to be paying the taxes from. And then, Lori, at the end of the year, when you file your taxes, you're going to have to do a reconciliation. If you did not yet pay enough taxes, you will owe taxes at the end of the year. Or it could be that they withhold too much in taxes, in which case you will get a tax refund at the end of the year. I see Robin is asking, are there income ceilings on traditional and Roth IRAs? Robin, there are ceilings on traditional and Roth IRAs. So there are slides that I had, which I did not really have the time to get into. But if you pay close attention, there are ceilings for Roth IRA. Remember, not TSB, not TSB. There are no ceilings for the TSB, but there are ceilings for the Roth IRA, and there are ceilings also for the traditional IRA. Benjamin is saying that the Roth balance is no longer subject to RMDs. That is exactly correct. That is awesome, awesome stuff. Teresa is asking, the law is supposed to be under the Secure Act that the employer match can be Roth. Why can't TSB do that? So, Teresa, that's a great question. I think that's a question for the TSB. The TSB has put out their guidance for the Secure 2.0 Act, and they have implemented some things. However, one of the things that they have not implemented is that the agency match be steered into the Roth. That is something that is not yet available. And when will they implement that? I have no clue, but it doesn't even seem to be on their schedule. Okay, fantastic. I see Victor is asking, when you need to take RMDs from your TSP, can you do so only from the traditional invested funds and leave the Roth funds untouched? So right now, Victor, they changed the rules in 2019. Yes, you could specify that the distribution comes from your traditional TSP and not Roth, or vice versa, Roth and not traditional. It used to not be that way, but now that is that way. Okay, Benjamin, you are correct about that. Okay, the mandatory distribution is no longer from the Roth. That is exactly correct. I see that Russ is saying something. If paying higher taxes is a real concern in retirement, then move to one of the 8 states. Okay, thank you, Russ. I hear that. And that is a consideration. Of course, that's a consideration. Victor is asking, prior to retirement and mandatory RMDs, can you roll over only the traditional portion of your TSP into Roth outside the TSP? Victor, yes, but Victor, let me tell you what you're going to do. You're not going to roll your traditional TSP into a Roth IRA. You're going to roll your traditional TSP into a traditional IRA. And then once it's in a traditional IRA, then you do the conversion into a Roth IRA. The reason why you want to do that is because if you go from traditional to TSP to Roth IRA, there is a mandatory tax withholding. The TSP will have to withhold taxes right then. I don't want you doing that. I want you converting the entire amount that into the Roth. So for example, if you took out $100,000, I want you converting all $100,000 into the Roth. I don't want you taking out $100,000. They're going to withhold 20,000 and you're only going to convert 80,000. I'm not going to do that. No, I want you to be converting the entire $100,000 and pay the taxes from an outside account. Fantastic, fantastic, fantastic. Okay. So let's see where we got over here. Someone's asked me a private question. I've been in traditional only last year and I changed to Roth. I'm sorry, I've been in traditional only until last year and I changed to Roth. Is that a mistake? No, I mean, I don't know if it's a mistake. Remember, my general recommendation is Roth, 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 but maybe you fit into one of my exceptions. So I don't know your situation. If you fit into my exceptions, then maybe you should switch back to traditional, but I don't know. Dawn, can you speak to backdoor Roths? So yeah, I mean, we can talk about backdoor Roths, but before we talk about backdoor Roths, let me just make something very clear. Nobody here has to do a backdoor Roth because you could do a direct Roth contribution via your TSB. You could do $30,500. So let me be very clear. The only time somebody needs to come to a backdoor Roth is if they've already done $30,500 into their Roth TSB, and then they want to do additional into the backdoor Roth. So if we're talking about such a person, that person, after they've done their $30,500 into their Roth TSB and they want to do extra money, so here's what's going to do. You're going to actually contribute that extra money, not to a Roth IRA, you're going to do it to a traditional IRA. And after you put that money into a traditional IRA, you will then roll over or convert that money from traditional IRA into a Roth IRA. Now, you have to be very, very careful about that, because when you convert from traditional to Roth, are you converting only let's say your traditional contributions that you've paid the taxes on, or are you converting the traditional contributions that you've not paid the taxes on? It is possible that you have traditional contributions that some of them are pre-tax, you have not paid the tax on yet, but some of them may have been post-tax, especially if you were not eligible to do Roth contributions, possibly because you're making too money, you might not be able to get the whole deduction. So if you have some of your traditional money, some of it is pre-tax, some of it is post-tax, and then you decide to convert from your traditional to Roth, and you don't convert the entire thing, you only convert an amount, a certain dollar amount, let's say $10,000. So that $10,000 is not going to be entirely non-taxable. It's going to be a pro rata conversion. So basically, we're gonna have to see how much of your traditional accounts is pre-tax, how much of your traditional accounts is post-tax. Let's give an example. If you have 90% of your money is pre-tax and you have 10% of your money is post-tax, and you convert $10,000 into a Roth, you're going to have to pay taxes on 9,000 of the 10,000, because remember, your traditional TSB was 90% pre-tax and 10% post-tax. I know that was very fast, but I hope you got what I just said. Fantastic. Shai is asking, what is an example of a non-qualified account, a mutual fund? So basically, Shai, it's any account that is not a retirement account and it gets taxed as a regular account, meaning it doesn't qualify for any special tax treatment. So Shai, it could be a mutual fund, but it doesn't have to be a mutual fund. It could be stocks, it could be bonds, it could be mutual funds, it could be ETFs, it could be real estate, it could be commodities. It's really any investment. However, that investment, instead of being invested in a qualified retirement account where it qualifies for special tax treatment, you put it into this non-qualified account. It's not a retirement account. It does not qualify any special tax treatment. It's really just a regular account. Okay, fantastic. All right, I know I'm overboard over here, and I see there's a lot of comments over there, so I'm sorry I can't address everything, but I'm really grateful that you guys hung out with me for the past hour. And let me remind you, if you want to talk with me more, I do offer that complimentary consultation. However, you got to click on that link now because it's about to go away. When we end this seminar, the links are going to disappear. So let me post the link one more time in the chat box. Okay, whoever here wants to click on the link, here we go, right over there. It's once again in the chat box, and I want to wish you guys blessing and success. I hope that this class was beneficial for you. And once again, I want to thank my clients and my members for supporting me and supporting the work that I do. Once again, you too could become a client and member. Click on that link, and we will have a discussion. Thanks for joining me today, everybody. I wish you blessing and success, and can't wait to see you on the next class, the next webinar. Have an amazing day.